Most people invest in index funds, but still don't fully understand which ones actually make sense for long-term growth. And because of that, they either pick the wrong ones or spread their money in a way that doesn't really help them. In this video, we're going to break this down properly, so you can understand not just what index funds are, but how to choose the ones that actually fit your long-term goals. Let's start with something simple. An index fund is a type of investment that tracks a group of companies. That group is called an index, which simply means a list of selected companies used to represent a part of the market. For example, the S&P 500 is an index that tracks 500 of the largest companies in the United States. So, when you invest in an S&P 500 index fund, you're not buying one stock. You're buying small pieces of all those companies at once. If you're trying to understand how to invest in a way that actually makes sense long-term, not just guessing or following trends, this is exactly what this channel is built for. You can subscribe if that's what you're looking for. Now here's why index funds are so important. They are built on something called diversification. Diversification simply means spreading your money across different investments so that one bad result doesn't hurt your entire portfolio. Instead of depending on one company to succeed, you're depending on the overall market. And historically, the overall market has grown over time, even though individual companies fail. Now, not all index funds are the same. And this is where most beginners get confused. There are different types of index funds based on what they track. First, you have total market index funds. These track almost the entire stock market. Not just big companies, but also medium and small ones. In simple terms, you're investing in almost everything. Next, you have S&P 500 index funds. These focus only on large, established companies that are already dominant in their industries. Because of this, they are often seen as more stable, but slightly less diversified than total market funds. Then you have international index funds. These track companies outside the United States. This adds another layer of diversification because now you're not depending on just one country's economy. Now, let's talk about something many beginners overlook, but it matters a lot. It's called the expense ratio. The expense ratio is simply the small fee you pay each year to keep the fund running. It might look small, but over many years it adds up and reduces your total returns. So, generally, lower expense ratios are better for long-term investors. So, how do you actually choose the right index fund? Instead of looking for the best one, think in terms of fit. First, define your goal. Are you investing for long-term growth, retirement, or general wealth building? Then decide your market coverage. Do you want to invest only in the US, or do you want global exposure? And finally, keep costs low by choosing funds with low expense ratios. Here's the key idea most people miss. Index funds are not about beating the market. They are about moving with the market in a consistent, low-cost way over time. And for many long-term investors, that approach is more reliable than constantly trying to pick winning stocks. Once you understand how index funds actually work, a lot of the noise in the market starts to make less sense. And you can focus on what really matters, consistency over time. If you want to keep building this kind of understanding step by step, you'll find more videos here that break things down in a way that actually makes sense.